Good morning, or good afternoon, excuse me, and welcome to the September 26, 2024 Sheriff's Office Retirement Plan meeting. I am David Weiskopf, County Administrator, and we'll start as we always do to my far left with introductions.
Catherine Pratson, Director of Human Resources and Plan Administrator.
Joyce Sapp, Acting CFO.
John Walter, Citizen Representative.
Lieutenant Joshua Crum, Sheriff's Office Representative.
Christopher Byer, Sheriff's Office Representative.
Heather Schrader, Recorder.
Thank you. And first up is the approval of today's agenda.
I'll move to approve the agenda as presented.
Second.
I have a first and a second. All those in favor signify by saying aye.
Aye.
Aye. Ayes have it. Motion carries. Next up is the approval of the August 22nd meeting minutes.
I move to approve the minutes from August 22nd.
And I'll second.
I'm trying to remember. I don't think I was that the one I wasn't here? I'm sorry. I'm trying to pull it up now.
I think you were, it was the next day.
So I was, okay.
Yeah.
All right, I have a first and a second. All those in favor signify by saying aye.
Aye.
Aye. Ayes have it. Motion carries. Moving right along, new business, Marquette Associates and Mr. Wing.
Thank you, Mr. Weiskopf, and good afternoon, everyone. So you see a number of agenda items to walk through this afternoon, and say it's a little bit of a different meeting here. I've been given the remote to control the PDF, so I understand with great power comes great responsibility, but bear with me if I forget to change the pages here and there. But we'll start, if you have your hard copy, and of course it's already not working.
I got it.
Got it? Yeah, let me try one more time.
We can totally scroll through, Pat, if you want to.
All right, so that was a bust. But in any event, if you could go to page 4, please, Heather, we'll start there. And quickly with the private markets update, now, as always, I'd like to bring your attention to how these data are unfolding as we get in more of the statements throughout the quarter. As you recall, these investments are reported on a quarterly basis and with a decent lag. So every time we do a performance report, we're reporting the current quarter information for all the traditional investments, but then the previous quarter's information for the private markets. So in between meetings, we'd like to give you a little bit of an update on how things are unfolding. So these are Q2 data. And what I'd really like to focus on is each respective asset class, and specifically the investment change column, the fourth one from the left, which gives you a sense on the underlying appreciation or depreciation of the assets within each of those. So we'll start up top at private real estate. Again, in that investment change column, you can see we saw depreciation of the underlying assets of around $23,000 so far in Q2. We still are waiting on one of the 3 funds, so that number is not final. If we think about that as a percentage of the beginning evaluation, 2 columns to the left, that's about 0.5%. So a negative 0.5% we're looking at right now, which is broadly in line with what happened with real estate in the second quarter. So that market remains under some pressure, given the dynamics that we've talked about previously, but this time being down about 0.5%, again, is largely in line with the rest of the market, whereas maybe over the past 12, 15, 18 months, the real estate holdings have been underperforming a bit. So even though they depreciated slightly, they were more in line with what's happening elsewhere. So we take a small positive away from that. And then if you look at private equity in the row below, again, that net investment change of down about $70,000. We have 6 of the 9 fund investment statements. So again, some negative impact from the change in valuation of the underlying investments. That works out to about 0.7% of the beginning valuation all the way to the left. Now, we don't have the private equity benchmark data yet. Much like these funds, it's reported on a lag. But I would expect that down 7% to be somewhat behind the benchmark data once it comes in. Now, on the bright side, if you look at private debt, this is one of the 3 areas that continues to perform well. We'll talk more about that asset class in the next agenda item. You can see the appreciation a little north of $57,000, about, we'll call it a little less than 2% of that beginning valuation, which was in line with the broader private debt market. Again, if you recall, over the past 12, 15, 18 months, private debt compared to equity and real estate is performing quite well on a relative and absolute basis. So when we aggregate all of those, again, in that investment change column down at the bottom, we're looking at depreciation of about $36,000. Again, there are 4 funds outstanding, so we'll see how those data come in. But that's about 0.2% of the beginning valuation. So in turn, you can think about that. Unless we get that negative investment change offset by the incoming data, then we will likely see a slight downward revision to the original reported Q2 return that we went through at our previous meeting, given the valuations have come in a little lower than where we began. So with all that said, that's our update. We'll provide another one in October to the extent we get additional data. But with that said, I'll pause there to see if there are any questions or comments before moving on. Okay. So if we go ahead to page 6, our next agenda item is going to be the private credit search. So if you recall at our last meeting, we did a pretty broad and detailed overview of the asset class. It's one that SORP has used historically, and we talked about the asset class itself, really its role in the portfolio, why institutional investors use it. And it was our recommendation to do exactly what we're going to do this afternoon, namely bring a manager search for the board's consideration. If you look at the background on page 6, just some high-level information to think about, again, why we're running through this exercise this afternoon. So up top, you see the SORP has a current allocation of 1.7% to the asset class versus a 4% target. If we think about that underweight from a dollar perspective, let's just assume the SORP's about $150 million. It's a little higher than that, but it's a nice round number. So if you think about 4% target versus the 1.7, we're about $3.5 million underweight the asset class. So with that in mind, that 1.7%, as you can see in the second bullet point, will continue to come down absent any changes to the private credit allocation, because those closed-end funds are in their distribution phase. They keep returning capital to the underlying investors, so they will continue to decrease. So with those coming down, coupled with the underweight, we are recommending the board approve a $3 million commitment to an open-end fund. And we talked about those dynamics at the last meeting, and we'll continue to talk about not just that, but much of what we covered as far as the characteristics when we discuss the relative merits between these two options as we work through the next several pages. But those are closed-end funds. We're talking about open-end funds today, which are not 100% liquid, but certainly provide more liquidity than we have right now via the closed-end funds, where you don't control any of the cash flows. The manager does when to ask for the money and when to return it. And then eventually, as they wind down, as we talked about in that last bullet point, we think it does make sense to essentially, if the board decides to add one of the two managers we're putting forth under consideration this afternoon, to complement that manager with a second. So in other words, you would have a 4% allocation to the asset class, split, we'll call it approximately evenly between the two managers. So whatever happens with today's decision, as the rest of the closed-end funds continue to wind down, we'll likely go through a similar exercise, maybe in a year's time or so, when it could be time to, again, bring another manager to the table, because we'll likely be underweight the asset class, because, again, those 3 funds are returning money to shareholders right now. So with that background, let's start on page 7. As far as the two managers under consideration here, we'll go through some data at a high level, and then we'll get a little bit more granular as we go along. But the two managers you can see up top, are Carlyle, their direct lending fund, and then TPG Angelo Gordon Direct Lending Fund. So these are two of the bigger managers in not just the private credit space, but also the private market space. And I'll provide a little bit more color on that in the next couple of pages. But as far as some high-level quantitative information, and as always, we'll try to lay out the relative merits between the two as we work through not just this page, but the rest of the deck. You can see up top from a firm asset perspective, both in the hundreds of billions of dollars, as we'll see on the next couple pages. These are all in private markets. It's where their exclusive focus lies. So they do other things in addition to private credit, but private markets is where they invest on behalf of their underlying investors. As far as the private credit assets under management, you can see both north of $20 billion. I'll talk about how long they've been investing in the space in just a minute here, but they have decently long track records and pretty high assets under management for managers that operate in the space. Now, as far as these respective funds, you could see the target fund size. So in other words, once, they're not trying to raise, money in perpetuity, they're trying to raise money for these funds. And then when they get to a target size, they're going to be content with that target to ensure they continue to implement the portfolio as they see fit. So Carlisle's a little smaller there. You can see a $1.5 billion versus TPG at $4 billion. And I'll circle back to that in a second. On the next row, you see expected GP commitment. So what GP means is essentially the firm itself. So they're the general partner in the investment vehicle structure. So essentially think about that as their skin in the game, right? So in other words, they are investing the firm's own money into the funds themselves. So the higher number here would be, generally considered more favorable. So Carlisle, you can see they're about 3% of the overall fund size and 1.5 for TPG. So both, again, kind of eating their own cooking, skin in the game. There's plenty of sayings out there that make my point, but the broader point here is that they are investing their own money alongside the investors themselves. Then you can see the team size below with TPG, about 70 investment professionals compared to 40 for Carlisle, so a bit larger of a team. And then the number of loans within the portfolios below that. So when you think about that, TPG has almost twice the number of loans than Carlisle, so it's more diversified by borrower since there are more borrowers. But you can think about it, the size of the check that they're writing or the size of the loans are relatively similar because, again, the TPG fund size is about 2 times the size of Carlisle, and then they have about twice as many loans. So the underlying investments are similarly sized. However, TPG is a little bit more diversified because they have more loans in the portfolio than Carlisle. And then the next 2 rows there, you see the historical default rate. This just gets at, how good they are at underwriting the potential borrowers. Obviously, lower numbers here are better. So Carlisle there, less than 5 basis points default rate historically, and TPG at 2. And we would argue that the TPG number is one of, if not the lowest one, amongst private credit investment managers. So again, just speaks to their ability to underwrite the potential borrowers and essentially assess their ability to pay back those loans over time. And they've experienced really limited to almost no defaults over their investment life. And then the final one, expected deployment, that just means that when you think about it, if you make a commitment to the funds early on, they're not going to ask for all of the money at once. So they're going to ask for it as they're ready to invest it. So with Carlisle, you would expect any commitment to be fully invested maybe 1.5 years or slightly longer, where TPG would be a little bit quicker, about 2 or 3 quarters. And we'll talk about why that is a little later on. I'll pause there for questions before we move on.
Oh, thank you. So I just have to understand
Yes, sir.
private credit. I know we've discussed it. I'm a business, I need $1 million. I can go to a bank or I can go to one of these private credit places. Why do I go to a private credit place instead of a bank?
You would go to private credit place because generally you might be able to find more favorable terms. Like we discussed at our last meeting, a lot of banks are exiting the business entirely, so that may not even be an option for a company. So by default, you would have to go to one of these managers in order to raise that capital. So think about it.
So that's what these 2 groups do, is they invest in companies that lend money.
No.
No.
They invest in all sorts of companies, and we'll look at that in a little bit. So if you think about a company, it will raise various forms of capital or money to fund the business, right? It can issue equity.
Are we investing in a lending company then?
You're investing in a fund where that pool of assets would be managed by either of these 2 managers that takes those assets.
In stock of Microsoft or whatever to make money? No.
No. So if these funds are raising money from investors, they will then take that money and make loans directly to companies who are borrowing the
Like
funds.
a big giant super bank that just does loans.
You can think about it from that perspective.
Are they regulated the way banks are? I mean, because, banks are the most heavily regulated, sector, right? And they're still probably the worst with ethics, so.
They are the worst.
But Wells Fargo, I'm talking about you. But what I'm asking,
Yes, sir.
what I'm asking though is, how are these regulated? Are they
By-
regulated less than a bank or more than a bank?
I think that they're not regulated as much as the banks for obvious reasons because they're in many different lines of businesses. But there are regulators that oversee these investment firms like any other investment firm. So the SEC's involved.
And this has been around for what, 20, 30 years?
Private credit,
Yeah.
about probably closer to 30 to 40 years, but it's become more.
You're not getting us into Bitcoins or something, are you? Because I don't
No, sir.
understand that at all.
No, sir. No.
I'm not trying to be flippant. I just,
No, not at all.
this is other people's money, right? So
No, understood.
I like the slow but steady, and I get that this is the new hot thing, but I don't know enough about it. So John Walters is shaking his head because I'm an idiot, or because you don't know enough about it, or
Oh,
because
because I don't think it's the new hot thing. I
oh, it's
think
not. It's the old hot thing.
It's a mature hot thing.
Mature hot. Okay.
So the
I'm not going to
guy-
add on to that comment, but so when I think about, so when we talked a little bit about at the last meeting, right? Not necessarily just what it is and how it works, but what role does it play in a portfolio? So let me just circle back to that a quick second. So as
A little bit above
yeah, so
bonds and stuff like that.
well, it would
right?
be almost equity-like returns, right? So when we talked about, I showed this sort of matrix of, what are we trying to do and what asset classes play what role. And in that sort of growth engine bucket, what's going to drive the growth of the portfolio to hit the 7.25% return over the very long term. We had equities, some other assets, and this asset class. So the expected return you can think of in sort of the high single digits, low double digits, but it's complementary in the sense that just based on the nature of what the investment is, it doesn't move in lockstep with equity, right? So there's a little bit of a smoother return pattern over time, and maybe when equities aren't doing well, this is doing well and vice versa. So not just diversification across the fund.
I get that it's diversification, but is investing in private equity good in good times or bad times, or
Well, we're not.
where's this going if there's a recession, or where's this going if there's a boom?
So it depends on a couple things, right? So if you think about how the returns are generated, like we talked about at the last meeting, the initial rate that the borrowers pay the lenders are determined by what's called a base rate. Okay, so essentially where short-term interest rates are, a spread or an additional premium on top of that due to the risk of the nature of making the underlying loan itself, and also origination fees, meaning that, much like if you do mortgage documents, there's an origination fee you have to pay to the bank. Same way here, the lender's acting as the bank, so there's an origination fee that the borrower has to pay. In turn, the return to the investor is largely just the yield or the interest being paid by the borrowers back to the investment fund itself. So think about it this, in like an economic boom, interest rates are probably a little bit higher, so your yield's a little bit higher. Companies are probably performing pretty well, so defaults are pretty low, so your returns are likely higher. When it's not going to do well is when short-term interest rates are very, very low, because then your base rate is low. And then if it's a recessionary type period, then the increase of or the probability of defaults likely increases as well. But over time, if you think about the dispersion of the returns from an asset class like this, it's much steadier than equities, right? We've never seen a period like I showed last time around where you had a drawdown in this asset class like the 35-40% we've seen in equities. I think the largest drawdown I showed was 6 to 7%, and that's why it kind of fits in that growth bucket, because in a sort of equilibrium, it's about an 8-9% return, but you get to the equity return even though you don't have 20, 25 plus, because you win by not losing, right? The shallower the hole you dig yourself, the easier it is to get out of over time.
Okay.
So I have two questions, if
Yes,
I may,
course.
just for clarification. When we see the word private in this, could they be lending to a publicly traded company, or are these recipients all privately held and not gone public yet?
The latter.
The latter.
Yes, sir.
Okay. So that is hoped for a part of your payoff later on, is it correct?
Correct.
And then down here on 7 at the bottom right, deployment of any money we put in 2 to 3 quarters. Will we see later on in this document what the projected payback time is, the length of the loans, or an aggregate of them?
Well, let's think about it like this, right? So the underlying loans themselves that we talked about last, the general maturity or term of those loans is kind of in the 3 to 4 year period. Okay, so as those loans mature in the closed-end fund vehicles that you have now, then you tend to get that money back right away. In this type of vehicle, it's the same underlying construct, but since it operates in perpetuity, unless you ask for money back, once a loan matures, then the investment manager is going to take that capital and then
They roll it over into
make
something
make
else.
a new loan, maybe refinance the company's loan that mature or lend it to a different company.
So unless we would ask for a matured loan back, it's turned into cash. It's just going to turn around and go right back to work again.
Exactly, kind of like a mutual fund. If you think about, or like a fixed income mutual fund where bonds are constantly maturing and the principal's paid back and they're paying interest, you can either elect to have your income thrown back to you in the form of cash or reinvested back into the fund. So it's the same construct here, is that since these don't have finite lives like your current investments and they operate in perpetuity, as the income is paid and the loans mature, those are reinvested by the manager back into new loans. Now, you do have the option that we'll talk about later on of liquidity, asking for your money back, and more importantly, probably kind of flipping on and off the income distributions, right? So you can have your income either reinvested back into the fund or paid back to you, which is a great way to really toggle the allocation, because again, the vast majority of the return is just the income itself because it's a loan.
And would we ever know who the ultimate recipient was of our dollars?
The underlying companies themselves? Yeah, absolutely. So that's information that is generally only shared with the investors, so not prospective investors, but if you were to make a commitment, then the manager would share that information so you can see the underlying companies. You probably want to walk through it at a meeting because it's very granular, but it's information that I could share with the board, certainly, so you could take a look at.
Thank you.
You're welcome. Okay.
Yep, thank you.
Of course, of course. So with all that said, why don't we start talking about the firms themselves on page 8, and then we'll get into really trying to draw out the characteristics, exposures, and the relative merits. So on 8 up top, you see Carlyle. They have 3 primary business segments. Again, global credit, global private equity, and something they call investment solutions, which is kind of irrelevant here. It's just a business line where they will, on behalf of, say, a plan sponsor like yourselves, kind of run the private markets program, right? So they won't go and make recommendations; they'll just do it on their behalf. Carlyle, you can see, has been managing the direct lending strategy since 2013, so a little bit more than 10 years, and they're one of the most active investors in the space, providing them with strong deal flow. So what does that mean? So that just means the number of opportunities or the number of loans they can take a look at is very, very high, which is important, because the more deals you can review, then the better probability you have of selecting good ones and avoiding bad ones, right? So for instance, if you had 100 deals come across your desk and you have to put money to work and you think, well, I got to do at least 10 of these, then maybe you do something that you otherwise wouldn't have done. But if you have 1,000 deals come across your desk and you have a lot of deal flow, you have a lot to pick and to choose from, and can isolate much better what you think is going to do good, and probably more importantly, avoid what you think isn't going to work out. And then as far as this fund itself, again, it's predominantly senior secured loans. So we're getting at this earlier as far as, and we talked about it at the last meeting, senior meaning that a company raises money via a number of avenues. It can issue equity, various forms of equity, debt, various forms of debt. But if you're senior, it means in the event something bad happens, you're the first one to get your money back. And it's secured, meaning your loan is secured by the assets of the company, much like our mortgages are secured by our home. And if we default, the bank repossesses the mortgage to obviously help itself accrue the loan it made to us. And then the other key difference here, you can see in that second to last sub bullet point, they operate in the middle market, and I'll talk more about that, and then principally in companies supported by financial sponsors. So we talked both about both those dynamics at the last meeting, but we'll talk more about them as we walk through some of the characteristics here shortly. And then later on, we'll see they have one of the lowest fee structures relative to the industry average. As far as TPG on page 9, sort of a similar construct in they operate just in private markets here, just real estate and private credit. Those two segments are via wholly owned subsidiaries. So you can see Twin Brook Capital Partners is the wholly owned subsidiary of TPG Angelo Gordon, and they do all the direct lending business for the firm. So private credit, like we're talking about right now. They have a team highly experienced. They worked together for more than a couple of decades. So they've been operating, like we talked about, the maturity of the asset class in it for more than 20 years. And then as far as the last few bullet points, it's the same story as Carlyle. The big difference is in the second to last bullet point there, where their focus is the lower middle market, so actually loans to smaller companies. And I'll illustrate that in just a second. But also, they, in addition to Carlyle, have a very low fee structure. So on page 10, now we're really going to dive into the underlying characteristics. So we talked a lot about, what all these various things mean at the last meeting, but now we can draw them out with specific numbers and talk about the relative merits of TPG versus Carlyle. So on the left, you can see up top that TPG has 100% of their loans are to sponsor-backed companies, and I'll give a refresher on that in a second. Where Carlyle to the right is 90% sponsor-backed companies and 10% non-sponsored. So what is a sponsor-backed loan? It means that the company has a private equity sponsor. So the company is either wholly or partially owned by a private equity company. Now, when a private equity company makes an investment like a buyout or something like that, they're not going to use all equity or all investor cash. They're going to borrow money to do that deal, and that's where the private lenders come into play. So why sponsor is thought of as a little bit less risky is because a private equity firm is already backing the company, right? They've already done the due diligence. They've already put investor money to work, and it generally leads to a little bit faster time to make the loan. And also it's generally thought of as that the private equity sponsor stands ready to inject more money into a company if needed. Whereas for a non-sponsored deal, it means there is no private equity backer. You're just making a direct loan to a company. So that's a little bit more complicated because the due diligence isn't already done. You have to start it from scratch, and there's generally a little bit of a longer process. But given it's a little bit of a longer process and not backed by another company, the yields on that tend to be a little bit higher, because there's no backer for the company already. So when we think about that within this construct, you could pretty intuitively argue that with TPG just focusing on sponsored companies, that it's a little bit more of a conservative approach than Carlyle, because they are making about 10% loans to these companies that don't have any backers from private equity. On page 11, just quickly from a geographic perspective, won't spend much time on this. You can see to the left, that's TPG again. All of the underlying companies that are making or doing our loans with are North American based. We use North America there. It's just the U.S. Where Carlyle to the right is the vast majority in North America, but they do have some European exposure. So they're, again, are sort of a global investment firm. So as a part of this strategy, there is about 10% to European-based companies because they have a worldwide footprint. Again, if you think about that, and I'll try to discuss the relative merits. If we thought of the previous page, TPG is probably a little bit more conservative. If you think about the geographic perspective, investing in the U.S., more mature, obviously, strong economy, probably a little bit more conservative as well.
What is ROW?
Rest of world.
Rest of the world.
Yes.
Okay. And going back to the term sponsored,
Yes, sir.
is that what we would think of as being venture capitalists?
No. So if we think about the private equity suite of strategies, venture capital is the most aggressive type of strategy in the private equity space, because they're generally investing in businesses that are very, very early in their life cycle, may not even have any revenue yet, may just be an idea. These would be backed by private equity companies in what's called generally the buyout space, meaning that they're buying or making investments in companies that are established, that have positive cash flow, positive earnings, and we'll see that data shortly to give you a sense not only what industry these companies in, but generally their cash flow profile as well.
Thank you.
You're welcome, sir. So with that said, if you want to go to page 12 and just a couple other slides on the characteristics, and then we'll get into some of the historical results. But the key on 12, and there's a heck of a lot going on this page. You can see the left, basically the industry exposures for TBG, and then the right Carlisle. But the key to this page is really, or the key takeaways are really twofold. Number one, in the two respective legends on the bottom to the left and on the for Carlisle to the left of that pie chart, you can see very, very diversified. So it's not industry concentrated by any stretch of the imagination. And importantly, most of the loans go to companies in non-cyclical sectors. So what do I mean by that? If you have a cyclical part of the economy, generally the demand for the goods and services of the economy is volatile and is dependent on the strength or the weakness of the economy. Whereas if you're operating in a more non-cyclical sector, it just means that the demand for the goods and services tends to be steadier over time. So if we think about that, and we'll just look at Carlisle to the right for an example, and if you look at the legend to the left going from top to bottom there, what are the cyclical industries? Well, generally in the middle of that list. So think containers, packaging, glass, wholesale, consumer goods, durables, automotive, things that are probably highly dependent on what's going on in the economy for the demand for those types of goods from the underlying companies. But importantly, they only comprise about 20% of the fund as a whole, and TPG, they comprise about a quarter. So if we think about the underlying companies and the business they operate in, the vast majority for both of them are in non-cyclical industries, again, where the demand, while it can fluctuate, fluctuates much less wildly for companies that operate in more cyclical industries that are, again, highly dependent on what's going on in the economy for the demand of their goods and services. So again, if you think about to the left for TPG and Angelo Gordon, that huge part of the pie there, the 32% in healthcare and pharma, right? Very much an industry which tends to have pretty steady demand for those types of goods and services. So again, a lot of the underlying businesses are in industries where there's fairly steady demand compared to industries where there's a decent amount of cyclicality for the demand for the goods and services provided by those companies. And then on page 13, this is probably one of, if not the most important or biggest differences in the underlying fund. So to your question earlier, Mr. Walters, what this is showing, you can see in the top title, borrower EBITDA. So that's, earnings before interest, taxes, depreciation, and amortization. Biggest takeaway, it's a proxy for cash flow of the underlying business there. So when you look at the breakdown for these underlying businesses, as I mentioned, TPG operates in the lower middle market. So if you look to the left, those first two bars is the 63% and 28%. More than 90% of the portfolio of the underlying companies have cash flow that is $50 million or less. So that's why it's the lower middle market. It's smaller companies generally thought of being more riskier. However, as I showed earlier, TPG had that 2 basis point default rate, which again just speaks to their ability to thoughtfully underwrite the creditworthiness of those businesses. Whereas if you look to the right, 85% of the underlying borrowers have more than $50 million in EBITDA. So these are the big differences between the two. Again, TPG operates in the lower middle market, smaller companies, where Carlyle tends to operate in the middle market, where larger companies, more cash flow, bigger businesses, a little bit more established. So from that perspective, you can think of Carlyle as a little bit more conservative than TPG. So if you go to the next page, and here we'll get into some of the historical results, and I'll focus on 14 for just a minute. It's probably more clearly illustrated on 15, but when you look at the top chart, what we're showing here, and you can see it, it's small up in the top left there, you can see total direct lending gross yield by vintage year. So what does that mean, right? So it just means that of the direct loans that these firms have made, what is the gross yield? So before fees and expenses by vintage year, meaning that in each of these respective years, what were the gross yields or the interest rates for the borrowers to pay back? Now we're showing it on a gross basis to make it somewhat apples to apples. We'll get into net returns and the fee structure later on. But even though we walked through some earlier slides that we'd argued showed TPG as a little bit more conservative, whether it be the geographic perspective, the number of issuers and things like that, that lower middle market versus the middle market drives higher yields, right? So smaller businesses generally have to pay higher rates to access those types of loans compared to companies in the middle market. So you can see outside of the most recent 2023 year, TPG has a premium yield to Carlyle. And the same data is showed on page 15. And again, this is probably a little bit more straightforward, where we're just showing it in a table. Again, the gross vintage year returns, you can see starting from 2015 on, in the vast majority, of those years outside of 2015, the returns are higher for TPG. Again, because of the lower market, they're able to charge higher rates for those companies. And then if you look at the bottom takeaway between the medians, the averages, the highest, and the lows, the greens, pretty intuitively supposed to illustrate that those numbers are slightly better to Carlyle. And Carlyle's not bad by any stretch of the imagination, but TPG has been able to generate better returns, again, largely because they can underwrite. They've had that strong underwriting process, and those companies are smaller than the ones Carlyle makes loans to. So then on the next page, and then after this one, we'll get into the terms and fees. So what this is showing, on the previous pages, we were showing gross yields, just to try to get to draw out, this is how they do it. This is who they're making the loans to. That's what impacts the rates. These are the net returns for the underlying funds they've raised over time. So like the current closed-end vehicles in the SORP, those firms tend to raise funds maybe every 2, 3, or 4 years. So that's what we're showing here. That's why some years are dashed out. They weren't raising a fund that year. Okay. So what you could see to the left, I think, is TPG's general consistency over time over the past 8 or so years, where they've been able to generate net returns to the underlying investors somewhere between 10.5% and we'll call it 12%. Whereas Carlyle to right's generally been in the high single digits, and then a pretty big outlier more recently, a little north of 20%, at a time when that base rate, right, that initial base rate is a heck of a lot higher. So if we had a number for TPG there, it would probably be maybe not upwards of 20%, but certainly higher than what we've seen between the 10 and 12% historically. But the large takeaway here, I'd argue, is that the consistency for TPG, which I showed on the previous pages, again, just based on the underlying companies they're lending to, generates an additional premium in yield compared to Carlyle, because the companies they're lending to are generally larger and more established. So a couple more pages here. 17, we'll talk a little bit about the terms, how things work, and then we'll wrap up on fees. So I want to talk about the redemption process and the subscription process for both, and probably should flip those because one comes before the other, but they are what they are. So from a redemption process perspective, remember, as I talked about, these are operating perpetuity, but they're not completely liquid. We'll call them semi-liquid. So the goal here is really to keep exposures to the asset class, but try to do it in a more liquid manner. So for TPG, how it works under the redemption process, basically they have rolling 3-year investment periods. and then investors may redeem with 180 days notice to the end of each period. So let's, what does that mean? So if right now they're in an investment period, we make a commitment, the $3 million is called, and then 6 months before the next 3 years, if we want some of our money back, we ask for it back. Now, in the interim, as I mentioned, the quarterly income can be distributed back to the fund even before the 3-year period ends. So you can kind of flip it on and off like a light switch. And since the income is the vast majority of the return, if you find yourselves notably overweight the asset class, you just turn it off, and then it should come down pretty dramatically, because then it's just kind of your principal sitting there over the next couple of quarters. For Carlisle down below, it's a little different. I'd argue it's a little bit more liquid. There is an initial 2-year lockup period, so that comes from the first date of the capital call. So if they call money, let's just say January 1st, 2025, then there's a 2-year lockup. Subsequent to that, there are quarterly liquidity options with 90 days notice. So basically every quarter with 90 days notice. So obviously 90 days prior to that, if we wanted to redeem any money, we would submit a notice. What they do in that is if they have money coming in from outside investors, they'll essentially cross it with the money going out. Now, if there isn't enough money coming in to offset what investors have asked for, essentially what they do is put some of the loans in a separate sleeve. It's called a slow pay provision. And as those bonds pay interest and mature, then the money's returned to the investors. But since the maturity of the loans is approximately 3-ish years, and it's paying 9-10% interest every single quarter, it tends to wind down, over a period of say 2 years or so. As far as the subscription process, you can see up to the right for TPG, they are in their initial fundraising period, and we'll talk about some of the benefits of that in just a minute as around the first close. But they're going to have this initial fundraising period, and then after that, they'll have really quarterly closes. That's fairly standard, right? So they're raising the fund right now for investors, and they're a little bit favorable terms for investors that first enter the fund. They call them generally like founders' fees, if you will. And we'll walk through that on the next page. And then as far as Carlisle is concerned, they're after their initial fundraising period, and they're just accepting subscriptions on a quarterly basis to be deployed over basically a 2-year investment period, meaning the 6 to 8 quarters I talked about a few minutes ago. So as far as the fees, as we wrap up here and look at pros and cons on page 18, as I mentioned, they're pretty low from an industry perspective. So we think about the closed-end funds in the SORP right now. The management fees are generally kind of 1.25%, and they all have performance-based fees. So for TPG, you can see the management fee is 90 basis points. So, around, call it 25% lower, maybe a little bit more than the fees we're paying right now to the closed-end investors. Now, that is lower than the stated fee. So Marquette has gone to TPG and negotiated this fee for our clients. So again, we don't receive any of that money. It's just a lower fee charged for our clients because we're fiduciaries and it accrues to the underlying clients themselves. But as fiduciaries, if we have a stick and the size and scale to do it, that's what we're going to do. So the fee's 90 basis points. They do have a performance fee, and that is pretty consistent with the industry standard, meaning that it's 15% over 7%. So what does that mean? Let's say they have a 10% return net of the management fee. That would be 3 percentage points above the 7% hurdle rate. So that 3 percentage points would be subject to the performance fee. So 15% of the 3 percentage points, 45 basis points, would go to the TPG, where the rest would go to the underlying investors. And again, that's fairly standard, and that's what the closed-end funds that you have now do. Whereas Carlisle, their management fee is just 80 basis points, and they have no performance fee. So like I mentioned earlier, that's one of, if not the lowest, fees that we've seen in this space. And much like I mentioned for TPG, that 80 basis points is negotiated with them for our for our clients who choose to invest. So pretty low fees, but obviously Carlisle a little bit more advantageous with the lower management fee and the lack of a performance fee. So with the pros and cons on 19 here, again, try to get the relative merits on one matrix here. as we think about wrapping up and some discussion. So for Carlisle, they have that large GP commitment, right? 3% of the fund. So they're investing a lot of the firm's own money into the fund. Generally more diversified from a sector perspective. They have those lower fees and more liquidity. On the con side, slightly lower expected return. Again, why? Because they're generally making loans to companies that are a little larger, where the interest rates being accrued will be slightly lower. And then on TPG, they have that larger team of professionals, more diversified by issuer. Remember, 125 loans versus the 60. That lower historical default rate and not just higher returns historically, but more consistency. But on the con side, you have those higher fees and less liquidity as well. So just to wrap up, as we think about these dynamics, obviously there's pros and cons. We have many clients invested in both of these funds. I think 40-ish in Carlisle with about $400 million in commitments. For TPG, it's a little less, maybe half that, with about $200 million in commitments. So these are two of our best ideas in the space. That's why we're talking about them this afternoon. Obviously, I don't think the board wants to move forward a wrong decision. The only thing I'll say is that TPG is a little bit more differentiated than a lot of the other managers out there, because most are in that middle market space. Okay, where they're predominantly focused on that lower market. So, if the board makes a decision today and then we come back eventually later on, there's probably going to be one of these two, whoever's not selected if you do move forward, and another manager that's probably more similar to Carlisle than TPG, because they generally, again, mostly operate in that middle market. So TPG is certainly a little bit differentiated from that perspective. So with all that said, it's a lot of information, a lot to think about. Again, happy to answer any questions or address any comments.
Is there, like a lot of the funds we have like a benchmark or whatever you call it, the S&P 500 or the Russell 3000, 2000, is there a private equity benchmark or?
So for the private credit asset
Private
class,
credit, I'm sorry.
No, of course. So we have a current benchmark because we have private credit allocation. So there's a benchmark that we're using in the investment policy statement right now. Mm-hmm. Industry standard is to generally use what's called the Credit Suisse Leveraged Loan Index, which is bank loans that are tradable. Because if you're going to think about it this way, if you were going to do this via the public route, that's what you would be investing in. And as we showed at our last meeting, at least historically, taking this approach is generally offered a return or premium over that, anywhere between about 4 and 5 percentage points with lower default rates.
4 or 5% over the benchmark.
Over the public equivalent benchmark. Yes, correct. Yes.
And these look like they've been around, I'm sorry, since like 10 or 12, 2010.
So so Carlisle's been doing private direct lending since 2013. The TPG guys have been doing it for more than 20 years.
If I'm not mistaken,
Yes,
isn't
sir.
Carlisle headed by the former Secretary of Defense, Carlucci? I think they were very fast out of the gate with the concept.
Yeah, they were one of the initial players in the space. I don't know that to be certain. I don't want to misspeak, but you very well could be right. But there were a number. It wasn't. I know for a fact it wasn't he alone, but he might have been part of the original founding partners for sure. No word on whether he's still involved. If it is him, though.
Well, just as a conversation starter, I'm leaning toward Carlisle.
Well, out of the two, right, it makes sense. So go that way. You said the benchmark would be the Credit Suisse, because that would be the public equivalent of tradable loans?
Correct. And that's the benchmark per the investment policy statement right now. Yeah.
I mean, has like Vanguard and Fidelity and T. Rowe, have they caught up with this? Do they do like a little index fund of this as well?
Well, there are no index funds.
Not index, but I mean a private credit.
Though they do not operate in the market there. No, it's generally firms like, you know, Carlyle here, or if you want to think bigger names that you may know, like a KKR or perhaps a Blackstone, Goldman Sachs.
We were into Blackstone before, weren't we?
There was a Blackstone fund that actually was a private credit fund, if you recall. That's a great memory. That then had spun the underlying investments out into an ETF that was then liquidated and used proceeds to rebalance in other parts of the portfolio. It had generally had a fairly high fee.
No, I
Yep.
remember
But no,
that one.
you're spot on. That was a few years ago.
Yeah,
Yeah.
long time ago. Yeah.
If I could,
Yes, sir.
what makes you lean more towards Carlisle than TPG? I'm just looking at the returns, and TPG has better returns over time on the high end and on the low
You're
end,
correct.
and they have a bigger team.
So I'm trading off the returns for,
Fees.
in the pro side, large commitment of the general partners. In other words, they eat their own cooking. They put their money where their mouth is. I like the diversification by sector, lower fees, and more liquidity.
But Carlisle is the one that invests in the
Unsupported.
higher one or the lower one?
They invest in the higher.
higher
They're in the
one, right.
middle market, right?
The middle
more,
market,
more
where
established,
G
more in the lower middle
He-
market.
So I think that's what I thought, and the main reason I would go to Carlisle is they seem a little bit more conservative. Right.
It's a little safer in the long
Right.
term. You're giving up the
Right,
higher
right.
reward.
Because TPG makes a little bit more because they probably, they'd probably loan to me, right? So,
Right, more risk, more
yeah,
reward.
more risk, absolutely.
It's a pretty strict underwriting process, Mr. Weisskopf.
Okay, maybe they wouldn't then.
Eric Adams.
And you, oh, geez, no comment on that either. But if you think about things here too, again, remember this is hopefully one of two eventual ones. So if the board is more comfortable with Carlisle now, in theory, and I don't want to get way ahead of myself, but if we come back in a couple years, we may bring TPG back, we may bring a different firm back, but you can think about it this way too. I talked about it earlier, kind of equally splitting the allocation, right? But if, we want to consider TPG, but it's a little riskier, then maybe it's not a 50-50. Maybe it's a 2-to-1, things like that. So there are different kind of levers and sort of different ways to build the mousetrap that we can be thoughtful of as we kind of,
And
finish
what are you looking
this.
for today? This is just a discussion, or?
This is a discussion, and as I laid out at the outset, we're recommending that the board approve a $3 million commitment to one of these.
To one of these.
That said,
And $3 million would be what percent? I'm sorry to go back to
a little
beginning.
less than 2% of the
A little
overall
less than
fund. Yeah.
2%, and we can go up to 4%, and that's what you were saying a year
The
from now.
yeah. So the target's 4. We have 1.7 now that is winding down.
Mm-hmm.
So the 4 would be a little less than 2%. So it would get us back to or closer to that, but over time, because remember, it's not going to be deployed tomorrow. It's going to be over time. So it's likely if the decision was Carlisle as opposed to TPG, we're probably coming back sooner than we otherwise would have, because it'll be a slower process to get back up to target at the same time the other funds are winding down.
Okay.
We have the cash.
Yes, sir. We later on you'll see it. But again, so if you think about the $3 million commitment, if we get that done in the next quarter, they'll probably call 12 to 15% of that in the first call, which is $350 to $400,000. And today we have more than $4 million. Right.
Well, again, I'm giving up the reward for what I perceive as the safety.
Safer, right.
Yeah, I guess I'm not seeing where Carlisle is safer in the presentation when we talked about that 10% of what they disperse out is non-sponsored and TPG 100% is sponsored.
It was the middle versus lower.
Yeah, it's really on page 13, Lieutenant, where you can consider them, I think, a little safer just because of the loans they're making to the underlying businesses themselves, right? So think about it safer from the borrower credit worthiness in the sense that if you're a larger, more established business, you have much higher cash flow, then, you're more likely to, be able to pay the loan back and then, be able to weather difficult economic times. So I think from that perspective, probably outweighs to some degree the sponsor versus the non-sponsor item I talked about earlier. Obviously, it would be cleaner if I walked through all this and I said, these
No,
guys
but the difference is basically how TPG does 63%, right, between 1 million and 24 million, whereas Carlisle doesn't even loan to that group.
What page are you on?
Oh, 13.
That's 13, yes.
But see how these guys loan to these, and they don't loan to anybody that makes that much versus, so you see, so Carlisle, whoops, I'm going too far. Carlisle deals with more, larger companies. I wouldn't say more successful, but just, more moneyed companies, which is what you meant when you said they deal with the middle
market.
And what we said about TPG is they deal with the lower middle market.
That's correct.
So TPG makes more money because the lower middle market probably pays a higher interest rate, right? Because they're not as safe.
Correct.
And I mean, they're not it's not J.G. Wentworth or, no income, no job, loan sort of thing, but it's,
And so what were you saying? If we did $3 million today, then we might come back and bring TPG back?
Correct. So if we're ultimately looking at, in our perfect world for the board's consideration, the 4% target to the total asset class, the $3 million today would represent about 2% of that. We already have 1.7% currently in funds that are winding down, so returning money back to the SORP. So then as that continues to wind down, we'll come back with another search for consideration to complement the manager chosen today. And if it's not Carlisle, then it's very likely TPG will be one of those two. I mean, it's very likely that the firm not chosen today is going to be one of those two because, again, these are our two
because
best
these are the two best ones. is what-
consideration. Yeah, and there are other good ones out there,
right.
but I don't see myself in a position that in 6-9 months, whenever we revisit this, that whomever is not selected today is not still in that top two.
Right.
Like I don't guarantee anything, but I can almost almost guarantee that.
But
So
in 6 months to a year, you'll show me the Fidelity private.
they tend to get their hands everywhere, but as of today, they're not in the business.
And then where would we be pulling this money from? The Allspring money market,
Sure. So if you want to,
0.5 million?
if you want to jump ahead, Lieutenant is on page 32 just quickly. So all the way down at the bottom, a few rows up, you see the Allspring Government Money Market Fund to the left, and there's $4.5 million in there right now. So we'll make the recommendation as Carlisle asks for the money, right? So let's say the docs are done, the first capital call would likely be in the first week of January. So then, probably in December, because we don't meet till late January, I'll say if we get these docs done. Carlisle will typically call probably about 350 of that number. We have the 450 here. Let's just take it directly from cash. But as they do that quarter in and quarter out, I don't want you to assume it's always going to come from there, because depending on what happens with markets, how these things shift, then I may come back and say, well, let's do it from here instead. But the initial one, certainly, there's more than enough cash to fund that initial capital call.
And it will take several quarters to fund the 3 million.
Yes. Yes,
So
that's
they
correct.
do their own version of dollar cost averaging or
Right.
whatever.
Yeah, you can think about it that way. Yeah, so if you think about it that way, as far as the dollar cost averaging, it would be more of a dollar cost averaging than TPG. All that said, to throw another wrench in that's the Fed is lowering interest rates, right? So if you think about TPG is going to put a lot of the money to work right away at loans with higher rates,
Right,
because
right.
that base rate is higher today. And as Carlisle does it over the next 2 years, I mean, we don't know what's going to happen, but it's very likely that base rate is going to be lower than it is today. So on the one hand,
Yeah, that's interesting to think back, because you would think when the Fed, like, what was it, like 2015, 2016 was your 2.5%, 3%, right? And if you think back,
zero.
Zero?
Zero.
Oh, no, I mean what we were getting for mortgages, I'm sorry.
Oh, yeah. Oh, yes. I'm
Us
sorry.
people,
Yeah.
yeah. But what I mean is they were still pulling that 10% sort of,
Right. In a very low rate environment. Correct. Correct.
so would it be right to say that they would pull more in an environment with higher rates, or?
Correct.
Right?
So,
I mean, I would
yeah.
think,
So
right.
again, the
But even if it goes down, they still did pretty well when it was
Yeah, so-
basically zero.
right. So if you look at page 15, if you will,
Right.
those returns, again, in if you look to the left, 15, 16, 17, those are all basically 0% interest rates. They're
Right.
still, high single digits, almost double digits. You look at 2022, why is that so much higher? Because rates moved up. That
Gotcha.
that
Yeah, I
base
see
rate
it.
moved
I see it.
up.
Yep,
Yeah.
yep.
So hopefully we're not going back to 15, 16, 17,
Right.
right? But we're probably going to be more in like a 22 type of environment,
I got you.
right, where rates are lower than they are today.
Okay. All makes sense. I'm comfortable with Carlisle.
Yeah.
I'm seeing another recommendation for rebalancing of 5 million. Can we continue the presentation and then look at the,
Yeah, that's separate, Lieutenant. I mean, we could certainly continue, but that's outside the scope of this discussion. Yeah.
okay. Yeah, I'm fine with moving forward with Carlisle for now.
I will entertain a motion.
Move to withdraw $3 million. No,
Commit.
I'm sorry.
Commit.
Commit.
Commit $3 million from cash in support of the Carlisle
Remember,
presentation.
it might not all be from cash. Right now, the first $300,000 draw is most likely from cash,
Right.
but in the future, he doesn't know where it'll come from.
Right. So just,
I'm just going to back off.
I'd say, if I may, a $3 million.
What happens when you don't give us a motion?
That's a $3 million commitment to the Carlisle Direct Lending Fund, full stop, because then we can determine from where to source that money over time at our subsequent meetings. So I did not make that motion.
Is that your motion?
Yes.
I'll second that motion.
Okay, I have a first and a second. Is everybody in favor? Aye. Any nays? Ayes have it. Thank you.
All right. So we have two searches today, if you recall, but you'll be happy that I put the more difficult one first. So we can look at, if we go to page, I think it's 21.
Is that Schroeder, right? Yep.
Yes, sir. Oh, I think it's working for me now, Heather.
Oh, now you're doing it.
Now I'm doing it now. I figured I'd give it another shot. So yes, if you recall at our last meeting, for some time now, Schroders has been on the watch list. So before we get into the search itself, just want to provide the board a quick update on how things are playing out. So up top, you see the data, which is a reprint from the Q2 report. If you recall, as you work your way from left to right there, returns haven't been, bad. I would say that they've been mediocre more than anything else. So we had them on the watch list due to underperformance in the back half of 2023. However, more recently, you see in the table below, so far quarter to date, pretty strong absolute return, but about 90 basis points behind the benchmark. So the underperformance has come back into the forefront after a pretty good year-to-date start, as you see up top there, where they had recouped some of their earlier underperformance. So given those dynamics, we talked about doing a search. So on page 22, we have a few managers for consideration. So as always, we always list the current manager first, and then the other two options for consideration are in alphabetical order. So I always want to qualify the discussion with that. But I'm not going to run through this entire matrix here, really just hit on the key components. But up at strategy inception up top, per usual, all of these strategies have been around for a couple decades at a minimum, and sometimes longer in the case of DFA, all the way to the right. One of the key differences is really in that third row where you see investment approach, where you see quantitative for Schroder and DFA respectively, and then fundamental for Causeway. So what does that mean? So quantitative is really managers that just look at various financial metrics. So say income statement metrics, could be cash flow, could be earnings per share, things like that. Balance sheet metrics, so things like leverage, asset turnover, things like that, and try to determine historically which of those metrics have led to stock outperformance. So it's a pure quantitative look at things. They're not meeting with companies. They're not talking to suppliers, management, competitors, other industry experts, just specifically from a quantitative angle, whereas Causeway in the middle is a fundamental manager. So after an initial screen to try and get, say, a focus list, then they are doing those things. They're going to management meetings, they're going to conferences, suppliers, industry competitors to try to determine which are the most favorable businesses to whom invest client capital. The other thing, the holdings there, you can see Schroder and DFA, pretty similar, up in the hundreds. That's fairly typical of a quantitative manager. They tend to be a little bit more diversified, whereas fundamental Causeway, a little bit more concentrated with around 70 holdings. And that does make sense or is intuitive for the top 10 holdings. So that's just how much do their top 10 holdings comprise of the entire investment vehicle. And not surprisingly, Schroder, DFA with more holdings have less concentrated top 10 holding, where Causeway just means around a third of the portfolio is invested in their 10 best ideas. And then the weighted average market cap essentially means what's the weighted average company size, so weighted by their size and the holdings percentage within the fund. So obviously the higher that number is, the more they have in larger companies. And as you can see with Schroder and DFA, particularly DFA, lower than Causeway. So there is exposure to smaller companies within both of those funds. For the ticker, the only thing I want to mention there is, if you recall, Schroder's is a commingled vehicle. So it's not a mutual fund. It operates very much like a mutual fund, but it's offered to institutional investors because it doesn't have to deal with the regulatory and compliance overhead cost of a mutual fund, and then they're able to pass along those savings to investors. And then you see the fees there, where Schroder's about 55 basis points, Causeway higher. That's generally consistent with a fundamental manager, and then DFA, who is well known for their lower fees at just 28 basis points. So what I'd like to do now on 23 is walk through high-level overviews of each of the strategies, and then we'll look at the underlying characteristics and returns. As far as Schroder's on 23, note up top, it's an all-cap product, meaning it invests in both large companies, mid-sized companies, and small companies. Quantitative a process like I spoke to, but generally what they're trying to do is look for quality companies that are trading at attractive valuations. So how do they do that? Second bullet point there, they analyze a universe of about 12,000 stocks, so a very large fishing pond, if you will, and then we'll invest in the cheapest third of those stocks. So that's the value component. They're looking for cheap stocks, lower valued stocks. And then of those stocks, they'll use quality measures. So things like I talked about earlier, profitability, the stability of that profitability, financial strength to determine the probability of outperformance. Quality is a kind of a well-known metric that has done well over time, basically winning by not losing. So they focus on, again, cheaper stocks that have quality characteristics. And down below, you can see they tend to hold hundreds of stocks, and they do have some constraints that are listed there. The biggest one is there is a decent amount of emerging market exposure. In the middle bullet point there, it's capped at 35%, but that is a differentiator compared to the other two strategies. So if you look at 24, and we'll go to Causeway, and this is probably the most different of the three, because again, up top we see the strategy employs a value-driven, fundamentally based bottom-up approach. So again, the bottom-up approach is getting out on the road, conferences, trade shows, management, suppliers, competitors, having those conversations and using them in the investment process. Now, they don't do that immediately. Doing it on the entire universe would take too long. So they screen the investable universe on a number of metrics. Company size, they have more allocated to large caps than the other two. Excess payout yield, what does that mean? Basically dividends plus buybacks relative to the company's local market. Remember, this is a non-US, so there's many, many countries. So they're looking for companies that are paying out more in dividends, buying back more of their stocks relative to their local country market, and then various other valuation components like price to cash flow. So once they screen all that, it comes down to about 400 stocks, and that's when they do the deep dive. That's when they do the fundamental analysis around all the various things that I spoke to a minute ago. And at the end of the day, you're looking at a portfolio of about 50 to 70 stocks. As I mentioned, they're around 70 right now. They do have constraints around countries and industries and a max position size of 5%. They will have a little bit in emerging markets, as I'll show here later on, but not nearly as much as Schroeder. And then on 25, for DFA, they use a consistent process across all their strategies where they focus on three, again, quantitative metrics, which have historically delivered favorable relative results. And that's really defined in the second line of that top bullet point, where they focus on size, value, and profitability. So as far as what that means, if you look at that sub bullet point, they favor securities with lower relative prices, meaning they're cheaper, higher profitability, and lower market caps. So higher profitability stocks, generally a quality characteristic, and lower market caps, smaller cap companies. And as I mentioned there, it's a strict research-driven process that minimizes style drift. What does that mean? We're hiring a non-US value manager, given they're looking for cheaper stocks. That's what value means. So essentially, they tend to deliver the exposures that investors want, where some other managers can tend to deviate from their benchmark exposures over time and maybe give off a return stream that's a little different than what an investor is looking for. Again, the portfolio is expected to hold hundreds of stocks. They also have some industry limits, and then you can see the max position size is at 5% at time of purchase, but it generally never gets up that high because you have more than 500 stocks in the portfolio. So if we go on 26, just want to give you an overview of what the sector composition and then on the next page the regional composition looks like, because I think it'll be helpful once we look at the historical return streams. And if you go back to some of the numbers I spoke to earlier where both Schroeder and DFA hold hundreds of securities, it's probably not terribly surprising that as you look at the relative differences between the manager allocations on 26 versus the benchmark, which is in black, generally, as you work your way from left to right, the biggest differences or bets, if you will, are usually Causeway. So if you look in the middle of the page, they're generally financials about 5 over from the left, much more of an underweight compared to the other two managers to the benchmark. As you continue to work your way left from right, you have things like healthcare, industrials, information technology, very different than the benchmark. They're overweight those areas compared to an underweight to financials because, again, everything has to add up to 100. So if you're underweight something, you have to be overweight something else. So if you think about the sort of a spectrum of how different these three look than the benchmark, it's probably DFA, followed closely by Schroeder's, and then Causeway making the most sort of tilts, if you will, relative to the benchmark due to the more concentrated nature of the underlying fund. And then from a region perspective on 27, this is slightly different because of the Schroeder emerging markets exposure, which you can see all the way to the right. So they have about 30% in emerging markets, and you can see compared to Causeway, which is closer to say 6-7%, and then nothing for DFA. Unlike the sector perspective, from a region perspective, Schroders and Causeway are probably pretty similar for their tilts, because if you're overweight something to the extent Schroders is, you generally have to be underweight other areas. So generally across the rest of the board, Schroders has notable underweights, whereas Causeway has a pretty big overweight to the UK and then a corresponding underweight to Japan and the Pacific ex Japan. And it's really just a fallout from their process. So unlike the quantitative managers, the bottom-based fundamental up guys have the constraints, but exposures from a sector perspective and a region perspective are really a fallout from that process. In other words, they invest in the best stocks as they see fit. If that would lead them to a very, very concentrated or different portfolio, then they may tweak it to get back in within those constraints. But generally, using that sort of approach will leave you to look, more different than the benchmark than some other quantitative approaches. And then as far as the returns on page 28, probably looking at them at the table below is easier to digest, but you can see over the 1 year period, all pretty strong returns, a little bit below the benchmark and a very strong up market there. Not terribly different, but as you begin to work from left to right, you'll notice a couple things. Number one, generally, Causeway has outperformed DFA a little bit consistently, whereas both have been consistent relative to that benchmark, whereas Schroders has lagged in the more intermediate time periods, but slightly outperformed over the 10-year. Now, one of the reasons behind that, or probably the key reason, is their emerging market exposure, because emerging market stocks have underperformed largely over that time period and have probably subtracted about, we'll call it, 40 to 50 basis points in returns over most of those intermediate and long-term time horizons. So in other words, from an absolute return perspective, Schroders would look much better, but still be a little bit behind DFA and Causeway. So if we just think about the 10-year, for instance, we estimate that instead of 4.4, they'd probably be closer to around 4.8, much more comfortably ahead of the benchmark, but still a little bit behind Causeway and DFA. And then on 29, before we wrap up with pros and cons, what's interesting is that, think about things from a risk perspective. The first row there is the annualized standard deviation, or the volatility of returns over the past 10 years. And Schroders actually had a pretty big discount to the other two. Why is that? It's the quality component, right? Typically over time, the stocks of quality companies tend to be less volatile because the demand for their goods and services tends to be steadier. So that's really what's driving the lower volatility of Schroders versus the other two managers. And also in the second row, the lower maximum drawdown as well compared to both Causeway and DFA. Now, importantly, when you look at tracking error, we've talked about that metric before. That just simply means how different do the returns look compared to the benchmark. So when you think about the exposures earlier on, right, Causeway being more concentrating, having more tilts from a region and sector perspective leads to higher tracking error, right? If you're looking different than the benchmark based on what you hold versus it, then it's likely your returns are going to be more different over time. Whereas Schroders is somewhat in the middle, and then DFA has the lowest tracking error because mainly they hold a lot of stocks and they don't have the emerging markets exposure that Schroeder does. And then that bottom row, we've talked about this before, that information ratio, generally thought as a measure of manager skill. Think of it as consistency. So the number will be higher, the better you do relative to the benchmark, and the lower the tracking error you have. So think about it. If you have low tracking error, you're making smaller bets, but the information ratio is showing how consistently those bets pay off over time. So that's why that's higher for DFA than Causeway, even though DFA's 10-year return is lower, is because they've made small bets that have more consistently paid off, whereas Causeway's made larger bets and there's been more, kind of dispersion of those returns versus the benchmark over time. So then finally, to wrap up on 30 from a pros cons perspective to try and tie everything together here. Pros for Schroeder, they're the current manager. It's always a pro from certainly an operational and administrative perspective. Again, they had the smallest drawdown. They've been the least volatile, but on the con side, they have the weakest long-term results and that off-benchmark exposure via emerging markets. So they do look very different than the benchmark. Whereas Causeway, they have the strongest long-term relative results, strong risk-adjusted returns per that information ratio. But on the con side, they've been the most volatile and they are the most expensive. And then finally for DFA, that strongest risk-adjusted return, that information ratio, right, the measure of manager skill, they are by far the lowest cost option, but they have been pretty volatile over the past 10 years. So with all of that said, as always, I will pause there for comments, questions.
The drawdown numbers,
Yes, sir.
could I assume that those might have been in the '08 period or?
This is over the last 10 years, so that's COVID.
Okay.
Yeah.
COVID.
Right, so then think about March, April 2020.
Do we know what the returns were coming out of the trough?
Coming out of the trough, well, let's kind of do the math here. So if we look at those, so if we think about COVID, that was, we'll call it almost a little less than 5 years ago. So if we look at those drawdowns and then go back to page 28 and look at the 5-year returns, you can see that both Causeway and DFA are well ahead of Schroeder. So even though they had a bigger drawdown, you can think about it as an accounting identity that they were able to rebound and recoup that much faster and outperform. So I don't know it off the top of my head, but I think we can triangulate it that way.
And what's the longevity of each of these? Do we have dates established?
Yes, sir. So this goes back to page 22. Top row for the strategy inception. So you're looking at about 18, 23, and 30 plus years respectively. So they've been around for quite a while.
And the DFA tracks the benchmark the most closely.
Yes, that's correct. So that's exactly what that tracking error number tells us on.
And it's the least expensive.
Correct.
Yeah.
So per Ms. Pratzen's question on 29, the returns are most consistent versus the benchmark compared to the other two. And then from a cost perspective, that goes back to page 22, where we're looking at about 55 basis points for Schroeder's, 88 Causeway, and 28 for DFA. So about half the cost of what we have right now with Schroeder's, and can't do that math, around 65% discount relative to Causeway.
Yeah.
Well, I'm leaning to DFA.
I agree.
Yeah.
If we can withstand the volatility, we have the lowest cost and what appears to be the strongest outcome anyway.
I like that they're most aligned with the benchmarks.
Yeah.
Yeah.
So just important per Mr. Walters' comment, understanding that they're more volatile. So if we do get a period where markets are under a little bit of pressure and they're behind, then that we should expect that, right? And that'll help us, if we recall back this, to not make the wrong decision at the wrong time, because per his other question, they tended to rebound much more quickly when the markets recovered. So that's why we do that market environment every single quarter, right? Give you that context to say, okay, this was in line with expectations or it wasn't. And with the latter, then we need to dig in further and understand what's going on.
Okay. If everybody's in agreement, I will entertain a motion.
And on 33, there's, yeah,
There's one
proposed.
written, yes.
Yeah, I was going to say, if I may, we could probably hold off, and then
Okay.
if you want to go to,
You want the, right.
yeah, we can handle everything at once. So you all want to just jump to 32 quickly. We have the recommendations page. So before we get into the specificity here, you can see the total assets up top, just under a shade under $157.25 million, up a shade under $3 million since we last met as equity markets. After a volatile start to the month, have recovered their ground, whereas fixed income has been performing very well as interest rates have come down. So that's generated some decent growth since the last time we spoke. If you look at the top right smaller table, just a quick look at where the asset allocation stands. As you look all the way to the right to the differences there, you can see we have a slight overweight to equities, nothing too much to write home about. In the private markets, the second one, that 2.5 percentage point underweight, that's all private credit, right? Or not all of it, but the vast majority of it, which we are mitigating, or we're hopefully mitigate with today's decision. And then in real assets, that's real estate. Probably not a bad place to be underweight these days. So if you think about the private markets and the real assets obviously being underweight, then we have to be overweight something else. And right now that's largely fixed income and cash. So with that context, the recommendations are in the middle column in the larger table. So if you work your way down that column, what we would then be recommending is a full liquidation of Schroeder, moving $5 million now into the DFA International Value Fund. In addition to that, as always, if you work your way all the way to the bottom, we're trying to minimize that cash held outside principal and move those funds to the Allspring Government Money Market Fund as we can. And I feel like I do this every meeting, but I'm going to call another audible here. We received a notice late last night that there's going to be about a $65,000 distribution from one of the private credit funds. So that 1.7's coming down as we speak. So instead of the 150 there, I would recommend we do 215, essentially what's going to come in, which in turn, going into the Allspring Government Money Market Fund would be approximately $246,000. So everything's summarized, as Ms. Pratson said, on page 33. So $5 million to Causeway, coming approximately from Schroeder. And then in that bottom row would be approximately $246,000 to the Allspring Government Money Market Fund, with 215 coming from the cash held outside principal.
Right, I'll make a motion to move $5 million from Schroeder to the DFA. Did I get it all in there?
Yeah.
And then $246,000 from cash to Allspring Money Market, $215,000 of that coming from the cash held outside principal.
I'll second.
I have a first and a second. All those in favor signify by saying aye.
Aye.
Aye. Any nays? Ayes have it.
All right.
Thank you, sir.
Thank you.
All right, moving on. Is that the plan administrator's report?
Thank you. We paid an invoice to Boomersheim, and it represented a payment toward the valuation report, toward the GASB report, for benefit calculations, a payment toward the benefit portal, or the portal for the participants, and then we pay 10 annual payments, and this is payment 2 of 10. So the total invoice is $5,723.
Move to approve the plan administrator's report as presented.
I'll second.
I have a first and a second. All those in favor signify by saying aye.
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 Aye. Ayes have it. Motion carries.
Thank you. And then the next meeting is October 24th. And then the second item for consideration is the schedule of meetings for 2025. And the proposed schedule follows the same cadence as as this year has.
I'll move to approve the schedule as presented.
Second.
I have a first and a second. All those in favor signify by saying aye.
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 Aye. Ayes have it, motion carries. Next up, any public comment? No. Seeing none, I'll entertain a motion.
Move to adjourn.
I'll second.
I have a first and a second. All those in favor signify by saying aye.
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 Ayes have it, motion carries, meeting adjourned.